Welcome back to Investing Talk Podcast.
Today we're looking at SELLAS Life Sciences Group.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis of SELLAS Life Sciences. It's a really fascinating company. It's a clinical stage biopharmaceutical company.
Right.
And to really get it, you have to understand the science first.
Yeah.
They're completely focused on, well, next-generation immunotherapy and these novel cell therapy candidates.
And immunotherapy, especially when you're talking about a smaller clinical stage company like this, it just screams high stakes.
Right.
So what's the core engine here? What's the science they're betting the whole company on?
Their lead asset, and this is critical to the entire investment thesis, is Gelinpepimut S.
Okay.
It's often just called GPS.
Much easier.
Yeah, much easier. It's an innovative WT1 targeting peptide vaccine, and it's designed to basically trigger a really powerful immune response against cancer cells.
And what are they targeting specifically?
We're primarily looking at its use in acute myeloid leukemia, or AML, and there's also potential in ovarian cancer.
So AML, that's a very aggressive, very difficult form of blood cancer. This isn't some small niche market we're talking about.
Not at all.
It's a huge addressable need, assuming the science actually works. But how does that square with their financial reality right now?
Well, it translates into that classic biotech profile. They are firmly in the pre-revenue or maybe minimal revenue phase. They aren't selling anything yet.
It's a pure research and development play.
Exactly. And that distinction is so crucial for anyone listening. Because of that profile, the company's value isn't tied to, operational efficiency or quarterly sales.
All about the science.
It's all about the science. The value creation is a binary event. It's either going to be a huge success or a significant failure. And it's all driven by these major milestones, like a successful clinical trial readout.
We'd classified this as a turnaround or inflection point biotech play then.
That's the perfect label.
Yeah.
The risk is, of course, extremely high, but the potential reward from, say, positive phase 3 data is genuinely transformational. We're talking about moving the market cap by multiples.
And the space there in immunotherapy and cell therapy, that's drawing massive institutional capital, right? It seems to be one of the few sectors that's almost immune to wider economic slowdown.
That's a great point. The underlying medical need is so great that it drives investment regardless of the broader market. That sector focus is a huge tailwind for them.
But only if their pipeline delivers.
Only if GPS delivers results over the next, say, 12 to 24 months.
Okay, so let's shift gears a bit from the science to how they're funding it. Because with any development stage company, you have to talk capital strategy.
You do.
And in the pre-revenue biotech world, that conversation always leads to dilution.
Indeed, and this is where things get really interesting and maybe a little challenging.
Yeah.
The recent capital movements here need a close look.
What are the numbers?
If you look at the company's shares outstanding, the number jumped from about 105 million shares in June of 2025 up to 142 million by November.
Wow. Okay. That is a staggering jump. We're talking about roughly a 35% increase in shares in just 5 months.
In a 5-month window, yes.
In the established market, that would just crush a stock. So what's the read here? Is this a desperate move, or is there strategy?
That is exactly the right question to ask. Most high-growth biotechs might see 10, maybe 15% dilution a year.
Right, annually.
Annually. So 35% in 5 months is extreme. But here's the context-driven interpretation. It signals very aggressive, very active capital raising. Management is essentially broadcasting, we have massive milestones coming, and we are going to make sure we have the runway to get there no matter what.
So the bullish take is they're so confident in the pipeline that they're willing to accept the short-term pain of dilution to fund it.
That's it.
But for that to be true, you'd need to see some serious evidence of investor conviction.
You would. And we actually saw some very concrete evidence of that recently. The company reported getting gross proceeds of around $31 million from warrant exercises.
And when was that?
In October of 2025.
Ah, the warrant exercise. That's maybe the most fascinating detail here. Why is an exercise by existing shareholders a stronger signal than just, raising money from a new fund?
Because warrants don't usually get exercised when a stock is doing poorly. They're typically converted into common stock when the share price is trading well, often significantly above the exercise price.
So they're choosing to buy in.
They are actively choosing to double down. This $31 million conversion tells us that existing shareholders, The people who know the company best were confident enough to turn their options into actual shares. They're essentially saying, we believe the stock is going higher.
That suggests some really deep conviction inside their shareholder base. It's not just new money coming in, it's the insiders, the people already there, rotating in deeper.
Exactly. You could call it accumulation phase dynamics.
Mhm.
When you look at the frequency of their capital raises this year, it suggests the market hasn't just tolerated the dilution.
It supported it.
It supported it, and maybe even improved the valuation multiples along the way.
Yeah.
This aggressive activity, it points toward management getting ready for some big news.
A company doesn't load up on cash like this if they're planning on a quiet year.
Not at all.
They are fueling up for the next 6 to 12 months of what have to be major data releases. So what should we be tracking? What are the key milestones?
The biggest stock drivers are always the clinical trial readouts. So phase 2 or even better, phase 3 data for GPS.
Yeah.
That's number 1.
Okay.
Then you want to keep an eye out for any FDA designations, things like breakthrough or fast track status. Those can shave years off the approval timeline.
And a partnership deal.
A major strategic partnership or a licensing deal for, say, Europe or Asia would be huge. It would validate their entire platform and likely trigger a massive price reaction.
And there's another piece here, a structural advantage that SELLAS has that could speed things up. It's their status as an emerging growth company.
That's a critical detail,
Right.
and it's often overlooked. Under the JOBS Act, that EGC status gives them a lot of regulatory flexibility. They have reduced financial reporting requirements.
Which saves money.
It saves money, and crucially, they can sometimes be subject to less burdensome clinical trial rules.
So it's not just about cost savings, it's about speed. It potentially shortens their time to market if the science works.
Precisely. It's an accelerator built right into their regulatory structure, as long as they hit their clinical targets.
All right, so we've laid out the bullish case pretty well, the funding, the conviction, the catalysts. But we have to look at the downside. This is a risky sector.
Right.
What are the two biggest unavoidable risks that an investor has to understand?
The first and the most obvious one is the share dilution we've been talking about. While we've explained the strategic reason for that 35% increase, the fact is, every share an investor owns is now a smaller piece of the pie. And if they need more capital in 2026, which is very possible,
Which seems likely.
it does, then we'll see even more pressure on the value of existing shares.
So that's the financial risk. But
Yeah.
the second one is, it's more existential. It's that binary outcome risk.
Correct. Risk number 2 is clinical development failure. SELLAS is pre-revenue. Its entire existence hangs on positive trial data for GPS.
So if the data is bad,
It's not a minor setback. It's a catastrophe. If a major trial fails to meet its primary endpoints, you could easily see the stock fall, not just 20 or 30%. We're talking 50 to 80%.
that's a classic biotech wipeout.
It is. It's typical for a major failure in this sector.
So that requires a very specific kind of risk tolerance. But how does the market's willingness to exercise those warrants, that $31 million, how does that balance out the clinical risk?
It acts as a major mitigation factor. It tells us that investors with, maybe deeper insight than the retail market are willing to take on that binary risk at these valuations. It suggests the smart money is already pricing in a pretty high probability of success.
Because if they thought the trial would fail,
Those warrants would just expire worthless. They wouldn't spend a dime converting them.
that makes sense. So let's weigh this up then. The risk-reward profile, how asymmetric is this trade?
It's highly asymmetric. On the upside, if GPS works and gets validated, the potential return is probably in the range of 3 to 5 times the current valuation.
A 3 to 5x return.
That's the kind of multiplier you need to justify the risk. But on the downside, you're looking at that 50 to 80% loss if the trial fails. You aren't just betting on a product, you're betting on the science itself.
So let's connect the cash to the timeline. That $31 million from warrants, plus whatever else they had, how much runway does that buy them?
We have to look at their cash burn. Late-stage clinical trials are incredibly expensive. Their burn rate probably moves around a lot, but if we assume a conservative quarterly burn of, say, $15 to $20 million,
Okay.
then that $31 million gives them runway well into 2026, maybe into the third or fourth quarter.
Which means they have just enough time, potentially, to get through those crucial data readouts before they have to go back to the market for more money.
That timing is everything.
Yes. The strategy provides the fuel to hit those inflection points without the distraction of constantly needing to fundraise.
And if they hit those milestones, the next capital raise will be at a much higher valuation and be far less dilutive.
So let's bring it all together. What is the single core takeaway for someone trying to understand SELLAS Life Sciences right now?
The core takeaway is this. The company is running an aggressive but strategically necessary capital strategy to fund these huge near-term clinical milestones. And the strong investor conviction we see from that warrant exercise, plus their focus on the high-growth immunotherapy sector, makes it a very compelling, though specific, story.
So who is this really for? What kind of investor and what kind of timeline are we talking about?
This is, without a doubt, for growth-oriented, highly risk-tolerant investors. You should be looking at this as a 12 to 24-month swing trade focused entirely on those clinical milestones. This is not for capital preservation.
And if you do decide to follow this story, you shouldn't be tracking earnings per share. What should you track instead?
Three things. First, their official cash burn rate from their quarterly filings to see how much runway they have. Second, any news at all about clinical trial enrollment or timelines. And third, any regulatory news from the FDA or partnership announcements. Ignore all the traditional accounting metrics for now.
So the key question is whether this aggressive capital raise gives them just enough fuel to get to the major clinical data we're expecting in the next year. It's a high-stakes bet on cutting-edge science and management's execution.
Make sure you subscribe to the show so you don't miss our next analysis.